helping you save money, build equity, and gain knowledge. Let's go. In today's video, I'm going to be breaking down the internal versus external factors of a mortgage interest rate. That way you can understand exactly why you're getting the interest rate that you're getting. Let's first focus on the internal factors to understanding what your mortgage interest rate is going to be. And they are your credit score, your down payment, your loan term, and lastly, your loan type. When it comes to credit, all that you need to understand is the better the credit, the better the interest rate that you're going to get. If you're in a position right now where you don't have any credit and you want to know how to establish credit, I'm going to leave a link in the description below to help you get to where you need to be. Next on our list is the down payment. Now, what you need to understand is the bank is looking at you as being a liability. They're lending you money to buy a house. So naturally, you're going to be a liability to them. The more money that you have to put down, the better the interest rate that you're going to get. Now, obviously there are some other factors that we'll talk about in a future video called PMI, private mortgage insurance. But for the sake of this video and to keep it simple, just remember the more that you have, the better the interest rate that you're going to get. Next on our list is the loan term. We have a 15-year mortgage, which offers a lower interest rate, but a higher monthly payment. And then we have a 30-year mortgage, which is the inverse of the 15-year. A higher interest rate, but a lower monthly payment. And lastly on our list, number 4, is your loan type. There are 4 basic types of loans that you should understand as a beginner or as someone who's maybe only bought one house in the past and needs a refresher course. We have conventional loans, which are backed by private lenders, FHA loans, which is backed by the Federal Housing Administration, veteran loans, or VA loans, which is backed by the Veteran Affairs, and lastly, we have USDA loans, which is for more of the rural areas. And again, these are just the 4 basic types of loans. There are other options, but again, for this video, we're going to keep it very, very basic. These are the 4 internal factors to understanding your mortgage interest rate. Next, let's flip over and talk about the external factors, and once we combine all these, how it's going to ultimately impact and help you understand what your interest rate is going to be. We're not going to spend a whole lot of time talking about the external factors, but I just feel it's important for you as a consumer to understand that there are things that are going on in the background that ultimately will impact what your interest rate is going to be. And the first thing on our list is the Federal Reserve, the FOMC, or the Federal Open Market Committee. And this is a committee that meets 8 times a year to talk about certain things that us as consumers should really be aware of. And if you want to know more information about the Federal Open Market Committee, I'm going to leave a description down below for you to check it out for yourself. But to highlight the importance of this, they talk about things such as employment, inflation, interest rates, and the overall direction of our economy. And this is ultimately going to dictate in which direction our economy is more than likely going to be going. Number 2 on our list is the bond market. If you haven't been following along with my TikToks, I'll go ahead and leave my TikTok in the description below too. I love to talk about the bond market, the charts, and how the 10-year Treasury plays such a pivotal role in how interest rates work. Number 4 on our list is the overall economic outlook. Where are the big players putting their money? Where are investors wanting to spend their time? What are they thinking about the trajectory of the market? These are all factors that we should really understand. Lastly on our list is lender competition. Everyone's going to be fighting for your business. People are going to be calling you, offering you better rates. It's up to you to decide which lender is going to have your best interest. And once you combine all these things, this will ultimately decide what your interest rate is going to be. Hope you enjoyed the video. If you did, go ahead and hit that like button. Don't forget to subscribe, and we'll see you in a future video. Take care.